There exists a market so vast, so obscure, that it has quietly grown to a scale that almost no one can truly comprehend. A market whose collapse could erase wealth on a global scale in a matter of days. In 2008, a smaller version of this market nearly brought the world to its knees. Today, it is 10 times larger, a $600 trillion web of bets, contracts, and obligations that entangles every major financial institution on Earth. Warren Buffett, long before the crisis, warned in 2003 that derivatives were financial weapons of mass destruction. Few listened. Those who did probably underestimated how prophetic that warning would prove to be. Derivatives are, in essence, contracts whose value is derived from the performance of an underlying asset. That sounds simple, almost mundane. A bond, a stock, a barrel of oil, even the weather itself, anything can serve as the foundation. But simplicity ends there. Derivatives allow speculation on outcomes without requiring ownership of the underlying asset. It is as if you could buy insurance on your neighbor's house, burning down and profit if the flames consume it. The morality of such instruments is irrelevant. The power and the danger lie in leverage, the ability to amplify a small position into a financial tidal wave. In 2008, derivatives did not merely contribute to the crisis, they amplified it, turning the collapse of a relatively small corner of the financial system into a global catastrophe. Lehman Brothers, once the fourth largest investment bank in the United States, reported assets of $639 billion and liabilities of $613 billion. On paper, it appeared solvent. Yet beneath the footnotes lay a hidden world. Over $35 trillion in notional derivatives, invisible obligations, and side bets spread across every major financial institution in the world. When Lehman faltered, the shockwaves reverberated instantly, freezing credit markets, destroying trust, and forcing governments to intervene with unprecedented sums. 29 trillion globally, a staggering figure nearly twice the size of the US economy at the time. The response was not reform, but expansion. Regulators required more transparency, some central clearing, reporting mandates. Yet they did not constrain the growth of the market, nor did they ban the most dangerous instruments. The world's largest banks learned an expensive lesson, but returned to the same patterns with new vigor, creating derivatives more complex and more leveraged than ever before. Today, the derivatives market dwarfs the entire global economy by 6 times. The implications are simple, terrifying, and immediate. When this market collapses, there will not be enough money in the world to contain the fallout. Most people, even investors, struggle to define what a derivative is, much less understand the peril they represent. Yet these instruments underpin every pension fund, every insurance company, every government bond, and virtually every global bank. They are designed, in theory, to reduce risk, to allow institutions to hedge against losses. In practice, they multiply risk, stacking leverage upon leverage, creating an invisible lattice of obligations that nobody can untangle under stress. A slight shift in market conditions, a 1% move against a large bank's position, can obliterate collateral. Multiply that by thousands of contracts across a network of institutions, and the fragile architecture of global finance becomes a powder keg. Credit default swaps illustrate the peril with brutal clarity. Intended as insurance against bond defaults, they were transformed into instruments of speculation. AIG, the insurance behemoth, sold hundreds of billions in CDS contracts without reserving sufficient capital. When the U.S. housing market collapsed, AIG could not honor its obligations. The U.S. government stepped in with $180 billion to prevent AIG's collapse from dragging every major bank into insolvency. And yet that intervention only delayed the reckoning. Derivatives survived, grew, and became more complex. The danger lies not just in size, but in interconnectedness. If Bank A cannot meet its derivative obligations to Bank B cannot meet its obligations to Bank C, and so on. What began as a single failure can cascade across the global financial network in hours, transforming a localized problem into a systemic catastrophe. This is what happened in 2008, and the blueprint has not changed, it has only grown. Today, the concentration of derivatives in a handful of U.S. banks, JP Morgan Chase, Citi, Bank of America, and Goldman Sachs, means the entire system's fate rests in the stability of 4 institutions whose balance sheets are larger, more leveraged, and more entangled than ever before. The real lesson of 2008 was clear yet ignored. Derivatives had become too large, too opaque, and too powerful for anyone to manage. The proposed reforms were superficial, ensuring only that the market could survive in the short term while creating conditions for an even more catastrophic collapse. Governments have no practical means to bail out $600 trillion in obligations. Printing money on that scale would collapse currencies, Borrowing on that scale would ignite global bond markets. Political will for such action no longer exists. Public trust in institutions has eroded, inequality has deepened, and the social license for another massive bailout has evaporated. As the global economy stands today, we are living on the edge of a financial precipice. Interest rate derivatives alone account for over $500 trillion of exposure. The Federal Reserve's rapid rate hikes from 2021 to 2023 created enormous unseen stress on these instruments. Credit derivatives, once thought fixed and regulated, continue to propagate risk on corporate and sovereign debt. Currency derivatives, vulnerable to global reserve currency shifts, amplify geopolitical shocks into financial tsunamis. And then there is the complexity. Derivatives built on derivatives, nested in layers of leverage so intricate that even their creators cannot predict outcomes under extreme stress. This is not theory. This is history repeating itself on an unprecedented scale. The same mechanisms that nearly destroyed the financial system in 2008 have been amplified tenfold, concentrated in a few institutions, and exposed to new triggers that could ignite cascading failures at speeds policymakers cannot match. The next crisis will not unfold over months. It will unfold in days, potentially weeks, with consequences that will ripple through every bank account, pension fund, and financial contract on the planet. The question is no longer if, but when. To understand why this market is so dangerous, we need to step back and examine exactly what derivatives are and why their very design carries hidden perils. At first glance, a derivative is merely a contract whose value depends on something else: a stock, a bond, a commodity, an interest rate, or even a currency exchange. But this simplicity is deceptive. Derivatives are not about ownership, they are about speculation, about betting on outcomes without ever holding the underlying asset. A derivative can be an insurance policy on someone else's debt, a wager on the direction of interest rates, or a bet on whether a corporation defaults. And yet, in their aggregation, derivatives form a lattice of obligations so dense that even the largest banks cannot fully map it. There are four primary types: futures, options, swaps, and forwards. Each serves a legitimate purpose in hedging risk. A farmer might lock in a price for wheat before harvest. An airline can stabilize fuel costs. A multinational corporation can manage exposure to fluctuating currencies. These are the modest, comprehensible applications. But the derivatives market as it exists today is dominated not by farmers or airlines, but by banks leveraging borrowed money to make bets on interest rates, credit risk, and currency movements. The leverage is extreme. A bank can enter a contract with a notional value of $100 million while posting only $1 million in collateral. That's 100 to 1 leverage. A 1% adverse move can erase the collateral. A 2% move can leave the bank owing money it does not possess. Multiply this across thousands of contracts in dozens of institutions, and the stage is set for catastrophe. History offers a brutal lesson. Credit default swaps, designed as insurance against bond defaults, became the spark that ignited 2008. AIG, the giant insurance company, sold hundreds of billions of dollars in CDS contracts without sufficient reserves. When the housing market collapsed, AIG owed more than it could pay. The U.S. government intervened with $180 billion to prevent total financial collapse, but the intervention was effectively a bailout of every major bank that had bet on AIG's solvency. Goldman Sachs received $123 billion, Merrill Lynch $6.8 billion, and dozens of other institutions received billions more. These losses did not disappear. They were transferred to taxpayers, revealing the fundamental moral hazard at the heart of derivatives. When they fail, someone else pays. And yet, instead of restraint, the response after 2008 was expansion. The Dodd-Frank Act created reporting requirements and pushed some standardized contracts through central clearinghouses, but the total market size was untouched. Dangerous products, credit default swaps, exotic options, nested derivatives remained legal. Banks argued they were essential for risk management. Regulators believed them or were captured by industry lobbying, and the market continued to grow. By 2015, the notional value of derivatives exceeded $600 trillion. Roughly 10 times the size of the market that nearly destroyed the world economy in 2008. To comprehend the scale, consider this. Global GDP is approximately $100 trillion. The derivatives market is 6 times larger. Even a small fraction of failure, say 5%, would equal $30 trillion in losses, 3 times the total cost of the 2008 bailouts. There is no mechanism to absorb such a shock. Governments are already over-leveraged, central banks cannot print without consequence, and political will for another bailout is near zero. Unlike conventional assets such as mortgages, derivatives are contracts between parties. There is no underlying asset to stabilize value. If a government intervenes, it is not rescuing tangible wealth. It is transferring speculative losses to taxpayers, a politically and economically explosive proposition. The structure of today's derivatives market compounds risk. Interest rate derivatives dominate, totaling over 500 trillion. When rates were near zero from 2008 to 2021, this exposure seemed manageable. But the Federal Reserve's aggressive hikes from near zero to over 5% by 2023 exposed hidden vulnerabilities. Losses accumulated quietly on bank balance sheets, masked by accounting rules that allow positions to avoid being marked to market. Credit derivatives, still largely unregulated, create exposure to corporate and sovereign defaults. Corporate debt in the U.S. alone has ballooned from $2 trillion in 2018 to over $10 trillion today. Many of these loans were issued at historically low interest rates. As rates rise and borrowers struggle to refinance, defaults will trigger payouts on credit default swaps, echoing the AIG disaster, but on a far larger, more complex scale. Currency derivatives represent another major vector of risk, totaling roughly $100 trillion. The US dollar, long the anchor of global finance, is under pressure as nations diversify reserves and trade increasingly in their own currencies. A significant weakening of the dollar could send currency derivatives into turmoil, triggering cascading losses across institutions that assumed dollar stability. Every market, stocks, bonds, commodities, and trade flows, would feel the shock. And then there is the complexity factor. Modern derivatives are often built upon derivatives of derivatives. Options on credit default swaps, swaps on indexes of swaps. This nesting creates exponential leverage. Minor fluctuations in an underlying asset magnify into colossal swings at the top of the derivative pyramid. Even the most sophisticated traders and algorithms cannot predict outcomes under extreme stress. Concentration further intensifies fragility. In the U.S., 4 banks, JP Morgan Chase, Citi, Bank of America, and Goldman Sachs, hold roughly 90% of all derivative exposure. JP Morgan alone carries $54 trillion in notional derivatives, 180 times its equity capital. Citi holds $48 trillion, Bank of America $37 trillion, Goldman Sachs $47 trillion. Combined, these 4 institutions maintain nearly $186 trillion in exposure, almost double the global economy. If one miscalculates, if one hedge fails, the losses could exceed capital many times over, triggering insolvency that reverberates globally. Sophisticated risk management, complex algorithms, and regulatory oversight offer no guarantee. History reminds us that complexity often masks vulnerability rather than preventing it. The interconnectedness of these banks is a mathematical trap. One institution hedges exposure with another, which hedges with a third, creating circular dependencies. If one fails, the others are immediately imperiled. This is not hypothetical. It is exactly what occurred in 2008. The derivative network is a spider web stretched taut over the globe. Break one thread, and the entire web trembles. Central clearinghouses were intended as a safety net, but they only cover standardized derivatives. The vast majority, customized over-the-counter contracts, remain bilateral, unhedged, and subject to the same cascading counterparty risks as before. Even clearinghouses themselves are now too big to fail. Losses exceeding default funds could force surviving members to absorb catastrophic losses, a mechanism that mutualizes risk and punishes prudence while rewarding recklessness. For 15 years, the market has survived without another catastrophe. That has created a dangerous illusion, stability mistaken for safety. The calm of low interest rates, low volatility, and central bank intervention has masked the fragility beneath. But the triggers are appearing. Interest rate volatility, commercial real estate defaults, European banking stress, sovereign debt crises, geopolitical shocks. They are converging. Each is sufficient on its own to destabilize the derivative web. Any combination could ignite a cascade faster than policy responses can react. The first trigger to watch is interest rate volatility. Over $500 trillion in derivatives are tied to interest rates. For more than a decade after 2008, rates hovered near zero, creating the illusion of stability. Banks and investors could take enormous positions without fear of sudden shocks. But from 2021 to 2023, the Federal Reserve raised rates from near zero to over 5% in just 18 months, the fastest hiking cycle in 40 years. Every upward tick created winners and losers across the derivative landscape. Some losses were visible, bank earnings reports, troubled loans, but most remained hidden, embedded in complex derivative positions that accounting rules allow to avoid immediate recognition. Even more troubling, the Fed now faces a dilemma: fight inflation or prevent recession. Either choice threatens derivative stability. If rates remain high, institutions holding long duration assets lose value. If the Fed cuts aggressively to fight recession, others lose on the opposite side of those bets. Flip flopping policy decisions amplify volatility further, creating margin calls and forced liquidations that cascade through the system. The models that banks rely on assume normal conditions, continuous liquidity, and solvent counterparties. None of these assumptions hold in a shock, meaning losses could vastly exceed expectations. The second trigger lies in commercial real estate. Over $2 trillion in commercial mortgages will need refinancing in the next 24 months, at interest rates 3 times higher than when they were issued. Many properties cannot generate sufficient cash flow to meet debt obligations. Defaults will trigger credit derivatives, specifically credit default swaps written on commercial mortgage-backed securities. The CMBS market is smaller than interest rate derivatives, roughly $600 billion. But a spike in defaults could still destabilize regional banks and ripple through the global financial network. Even localized defaults can propagate losses across institutions, especially when derivative contracts interconnect them. European banking stress represents a third trigger. Credit Suisse's collapse in March 2023 and its forced absorption by UBS highlighted systemic fragility. Deutsche Bank faces derivative exposure exceeding 40 trillion. A single European bank's failure does not remain confined. It spreads instantly through derivative contracts to US banks and beyond. The interconnection is global. A shock in Frankfurt reverberates in New York, London, and Hong Kong. Europe's banking system, burdened with high leverage and large derivative books, remains a weak point that could ignite a worldwide cascade. Sovereign debt crises are perhaps the most dangerous trigger because they combine multiple risks: credit, currency, and interest rates. Japan carries government debt exceeding 260% of GDP, the highest in the developed world. Inflationary pressures, global rate hikes, or investor flight could collapse the yen or trigger defaults on Japanese government bonds. The derivative exposure tied to these bonds is enormous. Losses would spread instantly across every major bank. China faces a similar challenge. Local government debt exceeds $13 trillion, much of it hidden in off-balance sheet entities. Real estate, comprising roughly 30% of China's economy, is in crisis. Developers like Evergrande and Country Garden have defaulted on hundreds of billions of debt. Western institutions, exposed through derivatives, could face direct losses, transmitting China's financial instability globally. Geopolitical shocks form the final trigger. A major conflict, say China and Taiwan, could disrupt semiconductor supply chains, crippling global technology sectors. An escalation of the war in Ukraine could trigger European energy crises. Conflict in the Middle East could send oil prices skyrocketing. Each scenario produces violent market moves that blow up derivative positions dependent on stability. Leverage amplifies these movements, creating losses disproportionate to the initial shock. These triggers are not speculative, they are emerging. Some are already active, others are quietly approaching thresholds of instability. The market's concentration magnifies the danger. 4 banks, JP Morgan Chase, Citi, Bank of America, and Goldman Sachs, control nearly $186 trillion in derivative exposure, concentrated bets that far exceed the entire global economy. If one bank miscalculates or one hedge fails, the cascade begins. Counterparties discover that their hedges fail. Margin calls force asset sales. Clearing houses face losses threatening their solvency. Within hours, every major financial institution could face losses beyond their ability to absorb. The 2008 crisis provides a grim template. Lehman Brothers collapse, 35 trillion in derivatives, frozen credit markets, eroded trust, and triggered global recession. AIG's collapse required $180 billion in government support, but that was only $60 trillion in notional derivatives. Today, the same mechanisms exist on 10 times the scale, with $600 trillion in derivatives spread across far larger, more leveraged institutions. Governments no longer have the capacity to respond as they did in 2008. Central banks cannot print enough money without triggering hyperinflation. Borrowing trillions more is impossible because global debt is already extreme. Public tolerance for bailouts has vanished after decades of stagnating wages and soaring inequality. The mathematics is unforgiving. Even a 10% failure in derivatives, $60 trillion, would exceed the resources of every major government combined. There is no theoretical bailout large enough to prevent collapse. Unlike mortgages or physical assets, derivatives have no intrinsic value to recover. They are contracts, pure speculation. Rescuing derivative traders merely redistributes wealth from taxpayers to speculators. The opacity of the market makes it impossible to even determine who should be compensated. In a systemic crisis, disentangling the web of contracts would take years, years in which the real economy would already be in free fall. The consequence is inevitable. Governments can intervene, central banks can inject liquidity, but the scale and complexity render intervention futile. Bank accounts may freeze, credit cards may fail, pension funds could collapse, erasing retirements. The economic shockwaves would trigger unemployment unseen since the Great Depression, supply chains would fracture, and social unrest would become unavoidable. Unlike 1929 or 2008, the speed of contagion in a derivatives cascade is measured in days, not years. The world economy could face a crisis faster than any institution could react. The fragility of the system is most visible when you examine the largest banks individually. JP Morgan Chase alone carries a notional derivative exposure of $54 trillion, roughly 180 times its equity capital. Citi holds $48 trillion, Bank of America $37 trillion, and Goldman Sachs $47 trillion. Together, these four institutions are responsible for nearly $186 trillion in derivatives, almost double the entire global economy. On paper, their positions may appear hedged. They argue that offsetting contracts reduce net exposure, citing net current credit exposure as a fraction of total notional value. But history shows that net exposure is fragile. Lehman Brothers and AIG both claimed their hedges were sufficient. Until counterparties failed, markets became illiquid, and their supposedly balanced positions became catastrophically unbalanced. These banks are interconnected in ways that are nearly impossible to untangle. JP Morgan may hedge with Citi, Citi with Bank of America with Goldman Sachs, and Goldman with JP Morgan. The dependencies form a circular web where the survival of each bank depends on the solvency of the others. If one falters, the losses propagate instantly. The 2008 crisis illustrated this phenomenon. Lehman's collapse triggered defaults across a network of derivative contracts, freezing global credit markets within hours. The derivative web does not allow for slow unfolding. It reacts instantaneously, amplifying small shocks into systemic catastrophe. Central clearinghouses were introduced after 2008 to reduce counterparty risk, standing between buyers and sellers of standardized derivatives. But these reforms only cover a fraction of the market. The vast majority, over-the-counter, customized contracts, remain bilateral, outside centralized oversight. Even the cleared derivatives carry systemic risk. Clearinghouses themselves are too big to fail. Losses exceeding default funds could force surviving members to absorb the shortfall. In other words, careful banks subsidize reckless ones, encouraging moral hazard while punishing prudence. Complexity magnifies risk further. Modern derivatives are derivatives of derivatives, nested and intertwined in structures so intricate that even the original designers cannot predict behavior under stress. Options on credit default swaps, swaps on swap indexes. This is not hyperbole. A minor change in an underlying asset can produce exponential swings at the apex of the pyramid. Models assume normal market conditions, continuous liquidity, and solvent counterparties. When any of these assumptions collapse, the outcomes become unknowable. Mathematics, not opinion, defines the danger. The four largest banks hold $186 trillion in derivative exposure. Global GDP is approximately $100 trillion. Even a modest 5% systemic failure equates to $9 trillion, already a sum larger than the total GDP of most nations. A 10% failure, $18 trillion, would dwarf the total resources of every government combined. Unlike traditional assets, there is no underlying property to absorb the losses. Bailouts do not restore value. They merely redistribute it from taxpayers to speculators. Attempting to prop up this system with emergency liquidity or debt issuance risks hyperinflation, currency collapse, and societal unrest on an unprecedented scale. The political landscape has changed drastically since 2008. In that crisis, public trust allowed governments to inject trillions into the system. Today, populism and polarization mean that any attempt to bail out banks would face fierce opposition. Wages have stagnated for decades. Housing affordability has collapsed. Wealth inequality has reached historic highs. Citizens understand that past bailouts saved institutions but left ordinary people behind. The social contract that allowed governments to act in 2008 has eroded. Attempting another bailout could trigger protests, strikes, and political chaos, compounding the financial disaster. The system today is beyond too big to fail. It has become too big to save. The banks are larger, more leveraged, and more globally interconnected than ever before. Their derivative books are 10 times larger than in 2008. Their balance sheets are labyrinthine. The financial ecosystem depends on them, but no institution, government, or combination of governments possesses the resources to rescue them if the market collapses. The mathematics is merciless. There is no bailout, no printing, no policy lever sufficient to stabilize a catastrophic derivative failure. And yet, the very structure that makes them so dangerous is celebrated as sophistication. Risk models, complex algorithms, and financial engineering are held up as proof of intelligence and control. But sophistication does not prevent disaster. It often enables it. Long-term capital management, a hedge fund staffed with Nobel laureates and the most advanced mathematical models in finance, collapsed in 1998, losing $4.6 billion in 4 months and requiring a $3.6 billion Federal Reserve organized bailout. Their derivative exposure was a fraction of what the 4 major banks hold today. Complexity created confidence, confidence encouraged risk-taking, and risk-taking produced catastrophe. History repeats itself in patterns that are mathematically inevitable. The philosophical reality is stark. Derivatives are contracts, pure speculation. They create artificial wealth that can vanish in hours. There is no intrinsic asset to recover. Attempting to prop up the system when it fails only redistributes losses from speculators to ordinary citizens. Allowing the market to fail would be catastrophic, but attempting to save it could be worse, introducing currency collapse, hyperinflation, and social unrest into the equation. Policymakers face a moral and mathematical paradox. The very tools designed to stabilize finance are insufficient, and intervention risks making the disaster exponentially worse. We are sitting on a $600 trillion derivatives market that is 10 times larger than the one that nearly destroyed the world in 2008. Multiple triggers are emerging: interest rates, commercial real estate, European banking stress, sovereign debt, geopolitical shocks, and each is capable of initiating a chain reaction. When the cascade begins, margin calls, counterparty failures, and clearinghouse pressures will converge, creating losses that no system can absorb. Within days, the global financial system could be in free fall. The lesson from 2008 was clear. Unchecked derivatives are weapons of mass financial destruction. Yet instead of disarming them, the system has grown exponentially. $600 trillion in derivatives now sits primarily in 4 banks whose failure could collapse the global financial system. Triggers are emerging simultaneously: interest rate shocks, commercial real estate defaults, European banking stress, sovereign debt crises, and geopolitical upheavals. In this environment, any single shock can ignite a cascade that spreads across continents in a matter of days. Unlike the Great Depression or even the 2008 crisis, the speed of contagion is unprecedented. Modern finance moves at the speed of electronic trading, high-frequency algorithms, and globalized banking networks. Losses are no longer localized. They instantaneously ripple through derivative chains, margin calls, and interbank obligations. A small miscalculation in one corner of the world can, within hours, compromise institutions on the opposite side of the planet. In essence, the system is not just fragile, it is a tightly wound clockwork of potential catastrophe, where each gear depends on the flawless operation of all others. And yet the illusion of control persists. Sophisticated models, risk committees, stress tests, and regulatory frameworks create a false sense of safety. But models are built on assumptions that fail under extreme conditions. Liquidity remains constant, counterparties pay, markets behave predictably. When these assumptions break, hedges unravel, derivatives explode, and the apparent safety nets collapse. The world may believe it is prepared, but mathematically it is not. The societal consequences would be profound. Bank accounts could freeze, pension funds could vanish, and credit systems could seize, halting commerce worldwide. Supply chains, already stressed by geopolitical tensions, pandemics, and climate events, would fracture. Unemployment could surge to levels unseen in generations. Governments, already stretched by debt and demographic pressures, would be powerless to intervene effectively. Attempts to bail out the system would likely trigger hyperinflation, currency collapse, and social unrest, compounding the economic crisis. Unlike past crises, where governments could print money or purchase distressed assets, derivatives are intangible, contracts without physical substance or inherent value to recover. Intervening does not restore stability. It merely reallocates risk and wealth, often from the public to private speculators. There is a harsh lesson embedded in this calculus. The financial system has outgrown the capacity of any institution, any government, and even any central bank to rescue it. The too big to fail doctrine of 2008 has morphed into too big to save. The tools that once appeared sufficient, the Federal Reserve, coordinated bailouts, quantitative easing, are now mathematically inadequate. The system's complexity, global interconnectedness, and sheer scale ensure that no intervention could restore confidence or solvency in a true derivatives cascade. Yet, despite the enormity of the threat, this is not merely a story of doom. It is a story of patterns and inevitabilities. Human behavior in financial systems repeats. Risk-taking fueled by leverage, complexity rewarded as sophistication, and crisis management postponed until the last moment. Warren Buffett's warning in 2003 that derivatives are financial weapons of mass destruction was ignored not because it was wrong, but because the potential profits were too seductive, and the consequences seemed distant. History demonstrates that financial innovations, no matter how dangerous, are eventually detonated. Derivatives are no different. The philosophical reflection is unavoidable. We live in a world where abstract contracts can destabilize entire nations, where leverage multiplies uncertainty into catastrophe, and where the illusion of control perpetuates risk. The systems designed to stabilize global finance have instead amplified fragility. The question is no longer if a crisis will come, but when and with what force. Our civilization has engineered its own vulnerability, balancing on the knife's edge of mathematics, politics, and human psychology. As 2025 approaches, the warnings are clear. Interest rate volatility threatens massive derivatives losses. Commercial real estate and corporate debt are primed for defaults. European and Asian financial systems remain interlinked with the US through vast derivative exposure. Geopolitical tensions could ignite shocks that cascade through every market simultaneously. The stage is set and the instruments are loaded. When the first major institution fails under derivative obligations, the cascade begins. There is no bailout large enough. There is no policy response fast enough. The mathematics is immutable. And so the future of global finance is poised at a crossroads. One path leads to sudden collapse, economic chaos, and societal upheaval. The other to a recognition that the system's fragility is now structural, that containment may no longer be possible, and that our assumptions of stability were illusions. The lesson is stark. Derivatives are not just financial tools. They are the architecture of modern risk. When the structure fails, the consequences will echo far beyond banks and investors, reaching every corner of society, every economy, and every individual reliant on the promise of a functioning financial system. The $600 trillion derivatives market is a monument to human ingenuity and human hubris. It is a creation capable of immense utility, yet equally capable of unimaginable destruction. As history has shown, every financial weapon of mass destruction is eventually detonated. We can study the mathematics, anticipate triggers, and understand the mechanics, but the inevitability remains. The question that remains in the quiet moments between the headlines and market tickers is this. When the cascade begins, who, if anyone, will survive? And what will remain of the world we thought was stable?